Financial security requires saving, but if you make the wrong decisions, your savings plan might become a financial nightmare. These frequent yet frightening errors could end up costing you more than you realize. These mistakes can deplete your funds and follow you for years, ranging from the worry that you won't save enough to not understanding account rules. Here's how to steer clear of the traps that could jeopardize your financial security. Horrible blunders in saving. However, other significant saving errors could wreck your finances. These systematic errors may also cause financial difficulties that follow you for years to come. A fear of being saved. The adage, the only thing we have to fear is fear itself, is correct. However, fear may be costly when it comes to money management because it can prevent you from putting your money in an interest-bearing savings account, which can result in missed interest. The idea that you won't have enough money to open a savings account is one enduring dread. While some accounts demand a minimum deposit of $100 or $1,000 to open, other accounts don't have any requirements at all, let alone charging fees for managing your money. Furthermore, you can contribute to your savings at any moment and without any predetermined limit. Thankfully, even a tiny contribution can build up. Chief Executive Officer of the Blue Ocean Global Wealth, Margarita Cheng, CFP, says, "People think that saving a little isn't going to make a difference. But even $10 saved every payday, especially if you have a spouse or partner that saves, will get you to $50 a month or $600 a year." Although it might not seem like much at first, things start to add up. Cheng has assisted her clients in overcoming financial obstacles that seemed insurmountable. She gave the example of a couple she has worked with for 23 years, who had little savings and a lot of credit card debt at first. They all began by setting aside $10 each pay cycle over the years. They maintained a regular and steady savings rate. Once their money began to grow each month, they were able to pay off their bills. She states, they started a 529 plan, paid off their credit cards, bought a house, had 2 kids, and paid off their student loans. And it all began with a meager $10 saved each pay week. Knowing what saving is and the many kinds of accounts that are accessible will help you overcome your phobia of saving. To begin with, the majority of banks and credit unions provide 4 main categories of saving accounts. Standard savings, an account that allows you to deposit funds and typically yields minimal to no interest. High-yield savings, an account that offers a significantly greater annual percentage yield. Usually banks that only operate online provide these accounts. Money market account, MMA. An MMA often allows you to access your money through ATMs and write checks, but it may have monthly withdrawal limits. It functions similarly to a savings account. A certificate of deposit, CD, is a scheduled savings account that can be opened for as little as 1 month and as long as 10 years or more, with the potential to earn interest on your funds during that time. For the term of the CD, the rate of return is usually predetermined, not utilizing early savings opportunities. Though it may seem absurd, some people frequently believe that they may postpone saving money until a better time in life, as they spend on such significant things as rent, food, and entertainment. Many teens and young people who are just starting have found it difficult to save money. However, if you can, it's worth the work to start early. As an illustration, suppose you're 20 years old and have $1,000 in savings or as a gift. By the time you retire at age 66, you will have saved more than $225,000 if you deposited the money in a savings account at a 5% APY, added $100 a month, and allowed interest to compound daily according to Bankrate's savings account interest calculator. However, you would have only saved $67,724 if you had postponed the same investment beginning at age 40 and using the same terms, not taking advantage of the employer's 401k match. A 401k is considered an expected benefit by a great number of people in the professional workforce, frequently being mentioned in the same breath as paid time off and healthcare. Employers provide their employees with a tax-advantaged retirement savings plan that allows them to contribute a portion of their pay up to a certain annual limit. Additionally, a lot of firms go above and above by matching 401k contributions up to a predetermined percentage of an employee's salary, typically up to 5%. However, don't undervalue this significant work benefit. A 401k with an employer match is a very effective instrument for accumulating the savings required for a comfortable retirement. With much enthusiasm, Chung declares it's free money, as the corporation is providing the funds exclusively to help with your retirement. Many employers are providing part-time employees with a 401k plan with matching contributions as an additional incentive. Chung points out that even her daughter, who works 10 hours a week at a clothes store as a part-time employee, receives a 401k plan with an employer contribution. For independent contractors and self-employed individuals, insufficient savings for taxes. It takes more than a 9-to-5 work for many Americans to make ends meet or earn a comfortable existence. Some people launch their own companies, some work as independent contractors, and still others use their side hustles to support their full-time employment. One component of self-employment and gig work that you can't avoid, regardless of the sort of job, is paying taxes on your earnings. Running your own company or picking up a side gig has benefits beyond just helping you get by. For many, it stands for a respectable company that needs to be properly structured, managed financially, and promoted through branding and paperwork. One way to help you organize your finances and manage your money more easily is to open a business bank account with a federally insured bank or credit union. This will allow you to set aside the money you need to save for Uncle Sam. Putting your savings and checking account at the same bank institution, it may appear safe, convenient, and assign a bank loyalty to open a savings account at the same bank or credit union as your checking account. What can you lose by depositing your savings, say, in a large bank you currently do business with that offers branch banking, online services, and nationwide reach? In actuality, you ought to inquire, what do I fail to gain? The annual response can be in hundreds or even thousands of dollars. Low APY savings accounts are typically offered by a large number of physical branches of so-called traditional banks and credit unions. One of the largest banks in the country, Bank of America, for instance, presently offers an extremely low 0.01% annual percentage yield APY on its Advantage savings account. After a year, if you have $10,000 in savings, for instance, you will receive an incredible $1 in interest. In contrast, if you deposit $10,000 into a savings account at an online bank like Popular Direct, which offers a 5.40% annual percentage yield APY, you will have $540 at the end of the year. Therefore, the bank will pay out more if the APY is higher. Online banks and credit unions typically have the advantage of offering higher rates and yields, not to mention lower fees over major banks, even though some of them can offer competitive interest rates on savings account. This is partly because they don't have to pay the overhead costs of maintaining physical branches, so they can pass the savings on to customers. Furthermore, the deposit account business is not as important to traditional banks as it is to online banks. Additionally, knowing that your money is secure is bolstered if an online financial institution is insured by the FDIC or NCUA. You're unaware of the conditions governing your savings account. Apart from unsuspecting expenses, such as administration fees, overdraft fees, or early withdrawal penalties on CDs, customers who bank at the same institution sometimes assume that the yield on their checking and savings account is the same. Even worse, some people are unaware of their savings account's annual percentage yield, APY. According to Mark Hamrick, senior economic analyst at Bankrate, it turns out that the devil is in being unaware of the details when it comes to maximizing return on savings and avoiding potential punitive fees. Why give up money you don't need to, or pay fines or penalties you can avoid? In certain situations, education is more valuable than strength, since it can result in bankable wealth. To sum up, while saving is essential for maintaining financial security, it's also critical to be strategic and knowledgeable about where and how to save. By staying away from some typical blunders, including putting off savings, losing out on 401k matches, or failing to read account rules, you may optimize your financial development and steer clear of expensive setbacks. You can make sure that your savings work for you rather than against you, and position yourself for a solid financial future by continuing to be vigilant and attentive. If you found this story eye-opening, don't forget to like, share, and subscribe for more insights and updates. Hit the bell icon so you never miss a video.